Hi there, and welcome to another video. Today I will be applying the PVGO thought process to Shake Shack, which has gone through a few changes lately that the market hasn't particularly liked. Apparently, the CFO, leaving, and the increase in store prices has worried some investors, and the stock price has subsequently suffered. With this latest dip, let's see if it's a good time to buy this very trendy company. Give a little bit of background on the company. Shake Shack started as a hot dog stand in Madison Square Park in 2001. From there, now they have become one of the major burger chains in the world. I would say the world. Their focus on high quality food and nice atmosphere has led to a bit of a brand following. This following may be able to power Shake Shack to his long-term goal of 400 plus restaurants, which to me it's a little bit ambitious once you start looking at the numbers, but we'll get to that later. Shake Shack takes more of a differentiation strategy in the fast casual space. This strategy involves being different by offering higher quality food for a premium. Shake Shack is also looking to expand internationally and license out their brand. Total revenue has grown by more than 50% annually since becoming a public company back in around 2012, 2013, due in large part to the large amount of restaurant openings. So a lot of that revenue growth is dependent on new assets, something to keep in mind. Based on these facts, the story I'll be telling for Shake Shack is more of a growth one so far, as the company is still trying to reach as many consumers as possible. This will lead to high cash flow generation, but also high capital spending, as most restaurants are standalone locations, which aren't cheap. It is not cheap building something from the ground up. You gotta figure out where to go, the land. Do they buy the land? Do they not buy the land? Building from the ground up is not easy, and it's not for the weak at heart. So there's a lot of planning that goes into it. Now that I have a kind of a preliminary story, let's get started with the PVGO thought process. Step one, let's look at the economic benefit used. So for most companies in this, we're growing stage, but we're not close to maturity. I prefer to look at gross cash flow. To me, I believe it's the most appropriate economic benefit based on where the company is at in their corporate life cycle. They're generating cash, and they shouldn't necessarily be punished for long-term investments. At least not yet. As you can see, Shake Shack has begun to hit their stride in generating cash flow. Now let's take a quick step back, just a quick step, and understand what it really takes to grow this economic benefit. First, you need revenue to grow, which in this case is connected to how many restaurants are open and the growth of the existing restaurants. How many new assets and the profitability of assets in place. Next would be controlling operating expenses. The expense Shake Shack has the most control over, well, the expenses that Shake Shack has the most control over are personnel, general and administrative, and pre-opening costs. Pre-opening cost is an interesting one. So that's already a way to leverage economies of scale. Once they get to a certain point, that cost will slowly but surely go away. Lastly, with new restaurants comes more depreciation. Since it's a non-cash expense, it must be added back. One idea to note is, since depreciation is connected to invested capital, it is possible for a company to increase their gross cash flow by large amounts by just growing their asset base. But the increase could potentially hurt the amount of free cash flow generated, which is the true measure of value creation. So that's just another thing to keep in mind, and I'll discuss that point a little bit later. Now let's move on to step two, calculating the discount rate. For the cost of equity, I began by calculating the inverse PE ratio for more mature companies in this food space. In this instance, it's McDonald's and Starbucks. And I back out just a modest 2% long-term growth rate, and I use 7% as the implied discount rate as a starting point. If you would like to know a little bit more about how I'm using this earnings yield kind of method to calculate discount rates now instead of a full-blown cost of capital asset pricing model, what's traditionally used, I have a video about it called the implied cost of capital. I'll put in the link, we'll put in the description below. I'll link it so you can kind of get a better understanding over it. Let's get back. I'm on a tangent. So we established we're going to start off with a 7% discount rate. Now I'm going to then add a size premium of 3% and a company specific risk of 4% to account for other factors, which are, there's a high investment rate, so very aggressive with their capital expenditures. It's already been shown that in factor investing, if you're more aggressive, there's a little bit more risk. Low margins. If you look at the margins, it's trailing 12 months operating margins. It's lower than usual, and that's expected. And negative free cash flow. And there's hidden debt. Let's not forget about that. There's hidden debt. Sure, it shows 0 on the balance sheet, but all their operating leases accounts for essentially 50% of all assets if you add them back in. It's about as many operating leases as total assets. So when you put all those things together, the cost of equity that I'm using is 14%. It was a little bit trickier to come up with a cost of debt because all of Shake Shack debt, like I've mentioned before, is in operating leases, meaning no debt is shown on the balance sheet. So I made a quick comparison in margins, size, and free cash flow generation to the mature companies, and just believe that a 10% cost of debt should be efficient for a company in a growth stage. If you're in this growth stage and you're looking for debt, it's probably going to be high yield, and that's about the high yield range right there, around 10-12%. Overall, with a 50-50 split in debt and equity, the weighted average cost of capital used was 12%. To account for the use of gross cash flow instead of free cash flow. That's another thing to keep in mind. This WACC is for if we were looking at free cash flow. We're not looking at free cash flow, we're looking for gross. So to account for that difference, I multiplied the discount rate by 1.4. And the reason I multiplied by 1.4 is if you look at McDonald's and Starbucks, the difference between operating cash flow, which kind of a proxy for gross cash flow. That comparison between operating cash flow and free cash flow is about 1.4. So we used that number, 1.4, and found the discount rate used for gross cash flow to be approximately 17%. Now on step 3. Let's take the calculations from the first 2 steps to find what percentage of Shake Shack's market value relies on growth expectations. So first, let's go back to step 1. Last 12 months, I take the 29 million in gross cash flow for the last 12 months and divide it by our adjusted discount rate of approximately 17%. And I get almost 173 million as the no growth value of Shake Shack. Now take the no growth value and divide it by Shake Shack's enterprise value of 842 million, resulting in nearly 80% of the market value deriving from the growth expectations baked in. This is equivalent to believing in Shake Shack having the ability to increase their gross cash flow by 5 times what it is today, implying a 5-year CAGR of approximately 37%. For a rough comparison, equity research analysts are projecting a long-term EPS growth rate of 25%. So the difference between earnings per share, net income, and gross cash flow, it might just be they're putting more assets into the ground. Now, these are some high expectations to live up to. Initially, based on where they are, maybe they can hit those expectations, but I'll need to further understand the fast casual industry a little bit more first. So let's start there. So the fast casual industry is one of the few spaces outside of technology that's growing faster than the national economy, and by a wide margin at that. A lot of the growth is driven by the major players, which are Chipotle, Firehouse Subs, Five Guys, and Panera. The growth is driven by a combination of millennials becoming more health conscious, wanting better quality food, and an increased amount of working professionals, which leads to less cooking at home and more eating at restaurants. Now, the industry has potential to grow by another 10%. I mean, it's already growing by double digits if you look at just the past 5 to 10 years. It has potential to grow by another 10% through the year 2020 due to more technological advances in the industry, as well as increasing home delivery capabilities. So overall, the industry is one of the hottest ones today, which means that in terms of revenue alone, Shake Shack may have the ability to grow at a high pace for the next few years, faster than the economy, maybe even as fast as projected. Now let's take a closer look at the major burger joints in the fast casual industry. The main competitors to Shake Shack are Smash Burger, Habit Burger, and Five Guys. Out of the three, Five Guys is the clear market leader, and the other two are trying to grow as fast as Shake Shack. That's very key. A lot of competition's coming up. A lot of competition, and it's not even considering the mom and pop joints out there. But what's also prevalent is Shake Shack is getting more out of each restaurant than their peers. For a quick comparison, if you look at the chart, Five Guys is not even getting $1 million per restaurant in revenue, whereas Shake Shack is approaching $2 million per restaurant. To get a better understanding why this phenomenon is happening, let's do a quick mode analysis. What makes Shake Shack so different? So first, Shake Shack just has a different vibe to it. Just the feel of the environment, kind of hipster, kind of clean. You know, for some reason, that dark atmosphere is kind of edgy. And because of it, there's a brand attached to the restaurant that Five Guys can't even match. Shake Shack also has secret items off the menu that you may or may not know about, as well as allows more customization for each storefront in terms of regional and veggie offerings. They are also the only burger joint offering alcoholic drinks, which are high margin items. And that's why a lot of bars are so successful. Shake Shack is already, Shake Shack is already in more countries than the three competitors combined. I mean, that's part of the licensing side of it. And it's a great strategy. I mean, put all these things together, this helps bolster the story for Shake Shack. In my eyes, I think they have the potential to grow revenues and therefore cash flows much faster than their counterparts because of this mode analysis. And with the modes in place at the moment, the growth may be able to be sustained for a while. There's already been studies that shown that, okay, sales growth can't last forever. Abnormal sales growth can. But return on invested capital, high returns, high profitability can be sustained for long periods of time. So Shake Shack might have something here. So with this in mind, let's take a look at what the current PVGO percentage is implying for Shake Shack in terms of growth expectations. So this is a quick scenario that I put together for Shake Shack for the next 5 years. As I've mentioned before, Shake Shack is, based on where they are right now, expected to grow at about a 5-year CAGR of a little bit over 37%. So let's try to break that down. How does that look? So the blue numbers represent the past figures, what happened in the past, and the orange numbers are the numbers that I control. So if you look up top, some of those numbers for projections are actually in black. Most notably, some of the restaurant count and count increase in revenue per store for at least 2016, 2017. And that's based off of what Shake Shack themselves have said, based off their management presentations. And I'm just using what they have already said. And the orange numbers are things that I believe can and will happen based on certain events. In the implied scenario for gross cash flow, this implied scenario that I've presented, Shake Shack will have to continue opening stores at a high pace, which could happen, especially once you start accounting for overseas. As those new store openings become a smaller proportion to total restaurants and same store sales continue to grow, and this is very key, the total revenue per store will increase. I also believe that pre-opening costs will decrease and overall economies of scale will lead to higher margins. To be honest, this implied scenario isn't that crazy. I don't know if it's 100% probable, but it isn't that crazy. I mean, it's kind of tough to keep up with those high restaurant openings, but if you're looking more at the licensing perspective, it could happen. So, I mean, based on this analysis alone, I believe that the market has hit the mark in terms of the market price of Shake Shack. I mean, it seems like this is a plausible valuation. I mean, so far it's looking like a hold based on the story that's already being told. However, the market price is not justified at all when looking at the implied expectations into a reverse DCF. I mean, and then this is where things get a little bit trickier. So remember we made that adjustment for gross cash flows for the discount rate? Yeah, we undo that adjustment. So the WACC is at 12% in the beginning. And we actually have the WACC coming down. It's something I believe in. Companies get less and less risky as time passes, as they grow. But in order for Shake Shack to reach their current market price, reach where they're at now, they will need to continue to open close to 20 restaurants a year for the next decade, as well as have more than 300 restaurants. So they have to keep up this high pace of growing restaurants for the next decade, while at the same time dramatically increasing operating margins and being much more efficient using their invested capital. Essentially, they need to bring the sales of opening company-operated stores, which brings in a lot more revenue, while having margins of a franchising model, this licensing model, which I find to be very unlikely. I mean, that's kind of tough to do. You need to grow 20 stores as well as become exponentially more profitable and control invested capital at the same time. I mean, unless you're going to go bargain hunting in terms of finding restaurant openings, which isn't their style. If you look at where their restaurants are at, where they specifically place their storefronts, they're usually in higher, well, how would I explain it? That's actually a good point. Well, where more money is made, more premium locations. So unless you go bargain hunting for that, which isn't their strategy, they are differentiation. They're a premium product. You can't put a premium product in discounted areas, so that's just not going to work. I mean, this is the only way I can make the numbers work. I mean, now part of this is expected. It is expected that if you look at it in a reverse DCF scenario, then if I was to extend the forecasted years out maybe to 15, 20 years, it may look a little bit better. It may not look as bad, but over a 10-year span, I mean, it looks kind of rough, and it's expected because Shake Shack is in a growth stage, and growth stage companies don't necessarily look the best once you plug them into a DCF. Now, I already said that the first 5 years look plausible, so I'm going to stay with that. So this is what I think would happen if you look at the company in a reverse DCF kind of scenario. In a more realistic scenario to me, Shake Shack wouldn't open as many storefronts down the road. Operating margins aren't as high, and the reinvestment rate would be more comparable to the average for a restaurant. The reinvestment rate for a restaurant is closer to 40-45%. So I think that's more feasible, and that makes a lot more sense. At a more reasonable long-term outlook, at least to me, Shake Shack's firm value is only $200 million, and equity value is close to $330 million. Or if you look at it in terms of where their market prices of today, it's only about 25% of what the firm value is in terms of enterprise value, and only about a third of what its market equity value is, respectively. So what does this all mean? Overall, I believe Shake Shack is a great company that's up and coming, but isn't the best investment, especially for the long term. Now, the current price looks reasonable for the next couple of years, if you're looking at more of an intermediate term basis. But a lot of magic needs to happen for the company to justify its current stock price in the long haul. If Shake Shack's market value somehow falls by another 15, 20, 30%, and the story hasn't really changed, then I would pay much more attention and may even buy a few shares. But as of now, Shake Shack is another example of a good company that I believe will be a bad investment. Thank you so much for your time, and until the next video, bye.